My name's Richard Parfit. I'm one of the managers, and I run the newly launched Real Assets Growth and Income Fund, which you'll be hearing more about tomorrow. But today, just wanted to introduce to you a couple of very interesting investment opportunities that we have within our portfolios, which is focused on private equity. So the scale of the private equity market by number of companies essentially dwarfs public listed markets. And it's fair to say that the exits from private equity houses often don't even go anywhere near the public markets. They're sold as trade sales to other private companies. And the companies that do make it to the listed markets today were probably founded 10, 11 years ago. And some of the best IRRs, some of the best returns have already been experienced through that period before the public markets see it. So it's crazy to miss out on some of those best opportunities. But that doesn't come without risk. Due diligence is required, and quite often a fair degree of hand-holding is required by the PE houses that nurture those early stage companies. And so it's with that in mind that I'm very, very pleased to welcome Ben Wilkinson, CFO of Molten Ventures, which is a PE VC house, has £1.3 billion of assets on its balance sheet, and it's held across various portfolios that we're running. And Ben was going to talk about this vital area of investment, and he's also joined by Mike Walters, the CEO of Form 3, which is one of the portfolio companies within Molten Ventures. So thank you, Ben.
Thank you, Richard, and thank you for inviting us along to speak to you about our company. The thematic that you've been hearing a lot about today, and I'm conscious we're coming towards the end of the day, but is about how you can get access to growth, how you can get access to innovation, and particularly AI. And just so happens that that's what we focus on. So that's the topic we're going to talk to you about today. I thought I would start first with a little bit about Molten Ventures. As Richard said, we're listed here on the London Stock Exchange. We're constituent of the FTSE 250. We talk here about how much capital we've deployed since our IPO. We have two IPOs in fact, the first one being in 2016 when we moved on to the junior market, and then in 2021 when we graduated up to the main market. And since that time in 2016, we've invested over £1 billion into underlying portfolio companies. The companies that we look to invest in are companies that are born in Europe. So Europe is our geographical spread. In the venture capital market that we operate within, the UK is about 40% of that European market. So just to give you a bit of context, the majority of what we do will be still within the UK, but we have a broad reach across wider Europe. And we're really looking at companies that are not at the earliest stage of their journey. So we like to see some proof points of commercial traction, but we're looking at companies that have interesting technology, that are in fast growing and significant size of markets, that can be global leaders in the space that they operate within, and that they have a point of differentiation and an inherent underlying IP. So the technology that underpins the companies is the important aspect. In terms of these headline stats, we've invested the billion, but we've also received back onto our balance sheet. We're structured as an evergreen balance sheet, so capital that we recycle from realizations comes back to be redeployed, and we've had £600 million coming back since that 2016 period. And I'll talk to you in a bit more detail about that importance of obviously turning our fair value of our portfolio into cash and the proof points that gives us, as well as the additional liquidity that gives us. And then some stats from our last reporting period, which was as of March, our year end. We have 1.4 billion of gross portfolio value. That then translates down into a net asset value of just over 1.2 billion. And I will talk a little more around the broader model, but we do manage assets alongside the balance sheet as well. And the benefit of that is that it gives us some income coming into the balance sheet. So when we talk about costs, the costs are being offset by the income structure. And a broad portfolio right now of 110 companies, like most portfolios, skewed to the top 20 names where the majority of the value sits, and we'll come into that as well. So for those that are less familiar with venture capital, I've actually just pulled a few of the slides from the British Business Bank's report And the British Business Bank puts out these reports, quite a broad cohort that they're looking at here, 2002 to 2018 in terms of the vintage year. But what I wanted to draw your attention to, and I might just come across here and point, is you have these bars for TVPI. TVPI is total value paid in, which is effectively the full value of the fund, including what it's distributed out, but also what it has remaining in the fund value. And this is for UK venture capital. And you can see the spread here of just over 1x to 2.5x. So this is often done on multiple of invested capital. So you're looking at how much capital has been paid in, and therefore what's the fund valued at that point in time. And you can see that range of distributions here, but you can also see, reflecting across to the US, that you'll have a broader range of distributions with some more at the top end. But actually, if you look at the medians, it's pretty similar. So the medians for venture capital are around a 2x multiple on your invested capital. You have to align that with this second chart, which is looking at distributions, and this is distributions of returns across managers. You have a blue line for UK, a green line for US, and a dotted line for the rest of Europe. And actually, the important part of venture capital, when you look at this, is quite how steep that curve is between your upper decile, upper quartile, and your median. When you invest in venture, it's very important to be in managers that are achieving this side of the line. And that's why venture is considered a risky asset class, because you can have a spread of distributions, but also if you're in managers that don't necessarily have the track record, you can be in scenarios where you don't get your capital back. And so what's very important about venture capital is obviously the managers that you trust with your capital and how they invest that through vintages. The time in the market is equally as important as picking your point of entry into the market. And so when I talk to you about our structure and how we mitigate risk and manage risk in our portfolio, it's worth bearing in mind VC as an asset class in its own right. So then moving you through to what does the European market look like? So first chart, we're able to give you a sense of VC versus US VC, because I think there's still a misconception that European VC will be the poor cousin. You can see the returns are actually quite similar, particularly as Europe has been maturing as a market over the last 10 years. And on the chart on the left-hand side, this is capital raised by deal size. So it's just how much capital is deployed in the market. And very similar to the US, you'll see peak period here in 2021. And in 2022, this was clearly the top of the market. But as you can see before that, and ignoring those two bars, you've actually got a trajectory of growth around 30% a year in the market ever since 2015 period. And so what we're seeing is a maturing of this market such that at the 2019 into 2020 period, it's over 60 million, having started at around 20 billion in size when we IPO'd this vehicle. This is only one quarter, so you can ignore that stat. But looking back to last year, it's starting to get back to those sorts of levels pre that peak trend. To put that into context, what you'll find is that is up still about a third the size of the US market. So in terms of where this market can grow to, and if you look at stats of capital deployed into venture as a proportion of GDP, but if you also look at the rate of IP that's created in Europe, it's equivalent to the US in terms of the IP, but we're investing a lot less per capita than in the US. So the gap that we have now can still close substantially further. And then this is mirrored in a similar way with deal count across the region. The important thing to look at on deal count is the blue bars here are the very early stage. These are investment checks of 0 to 2 million, so we'd call that seed stage investment. You'll see quite a lot of capital goes into the number of deals, rather. There's quite a large number of deals, but if you look on the left-hand side, it's a very small proportion of the actual capital. And the majority of the capital tends to come into very few deals at those later stages. And I'll talk to you a little bit about the life cycle of a company and how that mirrors into this as well. So coming back to the theme of the conference, technology has driven productivity, continues to drive innovation in economies. And if we see on the very left-hand side of this chart, first industrial revolution, not much changing as a proportion of GDP. And then this obviously is steepening in the last 100 years. And the line is accelerating. If you could kind of zoom into this part of the line here, the third industrial revolution, where we were looking at automation, handheld devices, silicon chips really driving a lot of that from Silicon Valley in the 1950s, 1960s. That's changed the way that we've been able to use mobile phone devices, launch rockets, the handheld computers that come with it. And that's now led into the compute power that's driving this next fourth industrial revolution. And I think it's the companies that we're investing into today, and this is why venture is very important to invest across vintages, because it's those companies that break out, and it might take them 10, 15 years before they're breaking out, but they'll be the ones that win significant market share. And I'll show you that venture is very much an asset class that's skewed to the winners. So you can manage your portfolio of assets. So if you invest in 100 deals, you can manage your portfolio of assets, but it's probably the top 20, 30% that are going to drive the majority of your returns. And therefore, you're in a business where you have to build portfolios and you have to be consistent about building them and getting access to different technologies. So how does that play into our existing portfolio and some of the themes around this industrial revolution, number 4.0? So we're going to touch on fintech in a bit more detail later on, but just to give you a sense of some of the names, obviously companies like Revolut are now, particularly in Europe, household names. They have over 40 million users, last raised capital at an implied valuation of 45 billion. When we invested in Revolut, we invested in their Series C round when they were valued less than $1 billion. That gives you a sense of where we're getting into the journeys on these companies. At the time when we invested, Revolut was still gross margin negative. So we're often investing in loss-making companies. Usually, the majority of what we invest in has an average gross margin of 70%. This was an exception because we could see that the market was shifting so quickly and that their ability to innovate products was so strong that we wanted to be part of that journey. And we invested about £8 million, just to give you a sense, which is now currently valued at the last round value about 160 million. So that's an example of where it can go right. You get multiple times your investment capital. Other companies, Form 3, we're going to introduce you to and talk in more detail. And then companies like Thought Machine, which is core banking systems, and Free Trade, which is allowing consumers to trade public stocks through their apps. Other themes, climate has been a big thematic over the last couple of years. We've invested in companies that are looking to create carbon markets and companies that are looking at scope 1, 2, 3 emissions for large corporates like Heinz, so looking at their whole supply chain and giving them the data behind that, how they can then report on their ESG. In the space arena, we've got low Earth orbit satellites like ICEYE, which take images of the Earth, and they can use that imaging for data products into, for example, insurance. So if you have a flood or you have a fire, they can take images of what's occurred, and then they can use that for the payouts, and that's creating an efficiency on those industries. In the healthcare space, we don't invest where there's clinical trials. What we're investing in is where the intersection of data and health come together. So we're interested in businesses like Endomagnetics, which was a breast cancer surgery device, Clue, which is a female health app, which has about 12 million global users, and then companies like IESO, which is looking at mental health services online. And mental health has a significant unmet need through the clinical practices, and if moving it online, in particular with cognitive behavioral therapy, allows you to meet a larger swathe of the population and to triage a larger swathe of the population. So these are areas where digital and technology can accelerate and even increase the size of markets by giving you access to a greater number of users. And on the AI and meta side, we've had a company, GraphCore, which we've actually exited this year. That was a silicon chip company based out of Bristol. It actually designed an intelligent processing unit, which was a chip specifically for machine learning, artificial intelligence. And when that company was formed, it was around the sort of 2017 period. Its main competitor was NVIDIA, and you could argue that NVIDIA won that battle, but that gives you a sense of the market opportunity. One company that I'll mention on this deep tech arena is Riverlane, based in Cambridge. That's a quantum computing software. So this is a software layer that sits across all of the quantum hardware. And over the next 2-3 years, we're going to hear a lot more about quantum computing, the power of that compute and how that's changing cryptography and how that's changing the ability to have nuclear fusion, for example. So you can think about all of these areas as connected, and the reason why we invest as a generalist across all of these is because they all link to other parts of the value chain. This slide is touching a little on our business model, and we tried to encapsulate a few things on this slide, so bear with me for a moment. But on the left-hand side, we'll have our investment process. I showed you a slide where we looked at the number of deals done in Europe, and there's about 7,000 to 8,000 deals a year done in the venture capital space. So we're screening thousands of companies. The stage that we invest at is important because at the seed stage, we've become a limited partner, which is an investor into seed funds. And we now have a program with about 80 seed funds across Europe, which are the first ticket into exciting technology companies. And they'll be across the Nordics, across the German-speaking part of the market, also into the UK and then into Southern Europe. So it's parts of the ecosystem where we don't have offices and people on the ground, but the technology is interesting. And at the seed stage, they'll be investing 500,000, 1 million, maybe 2 million into those companies. But the breadth of their portfolio will be much wider. So they'll be investing in 50 up to 100 companies, of which the winners in that portfolio will maybe the top 10%. And it's the top 10% that will then graduate to the next stage. So where we start to put our own capital to work from the balance sheet, but also I've got 2 boxes here for EIS and VCT funds, which are co-investment managed funds. We put that to work at what we're calling the early stage, which is effectively a Series A. So it's where a company has commercial traction, maybe 2+ million of revenue. They've got a team in place, they've got a product that's working, and then they're selling that. And that's the stage where we start to get involved. An important part of how we invest is not just the capital, but we invest our time. We sit on the boards of those companies, and that gives us the ability to help those founders to achieve their goals, to accelerate the businesses, to avoid some of the mistakes we've seen previously also, and to give us certain veto rights and controls within the company. So even though we'll be a minority investor and our average equity stakes will be around 11%, we'll still have significant control by our board positions. And also the fact that the risk around venture capital, the management of that risk, it's a syndicated model. So there'll be us as a venture capital firm, but you usually have 2 or 3 other venture capital firms around the cap table or the board table in this case. And that allows that risk to be syndicated. So in this model, I used to work in the oil business, and this is very similar to how you will think about geological risk of an oil well and sharing that risk between different parties. As we move into the growth stage, this is where we consider it to be a Series B investment. The company's then started to scale. It's got more customers. It's been upselling into those customers. And it's at the stage where it's ready to enter new markets. And that's when you'll put significantly more capital to work and you will increase your equity in that business for the next stage of that journey. Quite often with venture, it's like a relay race and you're passing the baton to the next lead investor. And what I mean by that is the next investor at each stage will often be the majority ticket for that round. So in a Series B example, if the company's raising 30 million, the lead investor will probably be putting 40 to 50% of the round together. They will then take a seat on the board alongside the earlier stage investors. And that's also a method of how the capital is managed and triaged through the journey. Because we have an evergreen balance sheet, we're able to look at our portfolio over periods of time and think about that capital allocation quite differently to some of our competitors who will live in a fund world. So they'll raise a fund. A fund will have a 10-year life, and so they've got to invest that capital and then harvest that capital within a defined period of time. We have the benefit of being able to stay with our companies for longer. If they continue to grow, if they continue to show that there's significant market share still available, we can put more capital to work in those businesses. And I think that gives us an advantage over some of our competitors. As that company life cycle continues, the growth continues, they move into the later stage. The exit point of our journey, 80% of the time the exit is pre an IPO. So they'll quite often be sold into large corporates, or it might be a private equity roll-up in a minority of situations. The majority of time what we're seeing is an outsourced R&D model where large, particularly US corporates will be wanting to buy the technologies coming in, and that's the majority of our returns and our realizations. And as I say, we've had over 600 million now to date, with over 100 of that done just this year from exits in our portfolio. This is a sense of the portfolio and how we put that into different categories. We keep quite broad categories, and within these 4 pillars of consumer technology, we're selling to consumers, enterprise technology, selling to corporates, and then hardware and deep tech, and then finally the 4th being digital health and wellness. You've got a lot of sub-thematics of technology like climate, like fintech that I mentioned, and so within this there's quite a lot of crossover, but you can see the majority of what we invest in is selling into corporates. It's large recurring revenue models that we're usually investing into. This slide is giving you just a bit more of a sense of that seed program. There's a bunch of logos really, but it gives you a sense of the breadth of the geography that we're covering with that, and we think that that's quite unique in the venture capital ecosystem, in that we have 2,000 underlying companies that we're monitoring and have the data on every quarter. So it gives us a jump on the next investments that we want to make by mapping this. And actually the returns are good. The managers we invest in have 2x to 3x track records, but it's the data that we're more interested in reality. So I said at the outset that we have this 110 company broad portfolio, but it's the top 20 that you really need to consider. This is the slide that we present every 6 months to the public markets, and it shows our largest assets. And if we look at how we present this information, we'll have the opening balance sheet fair value position, any investments we made in the period, then looking at the fair value movements, which are in the green, and then we'll have fair value decreases, which are in the red. And it's important to point out that the valuation of the portfolio through the journey is an important part of our communication tool with our investors, but also an important part of the journey to show our investors that we're being prudent in that approach. And so we'll make adjustments to these based on the commercial traction of those companies. And we talked about exits being the ultimate litmus test. When people are monitoring over several periods of time, which Richard has done with ourselves, he will see how we mark the portfolio and then ultimately where we sell the assets. And that gives that confidence of our approach. And we're always selling our assets above where we've been holding them in the books. And that's something that we'll continue to achieve by being sensible about writing the companies down if not making traction, but also being very slow to write them up. The growth in the portfolio is underpinned ultimately by the growth in the revenue and the commercial traction of those businesses. And if we just look at 2 of the other charts, which we demonstrate, on the left-hand side, we have our P&L returns, and you can see over the financial years, that's mostly been positive, but we've had negative returns in that period where the market has corrected. And we were very quick to take down the value of our portfolio in line with the public markets to ensure that the multiples that were being demonstrated for technology companies were quickly reflected through. And I think that's clearly important, but also it's an important component of the confidence that we can give to the market by making sure that we're valuing these prudently. And there's a couple of dotted lines there. The first in the yellow is our target returns. We call it through the cycle, but our target returns are 20% on the portfolio. So we are able to deliver that through that commercial traction of the companies, their revenues growing, if multiples are staying equal, obviously, but also through them raising additional capital. And when the companies raise additional capital, if there's third-party capital coming in a market price discovery process, that's when we've got the ability under the valuation guidelines to move those companies up. What we will often do as a house is take that round value, but take a discount to that and then move them up a little bit more slowly once we see the commercial traction coming through. We think that gives us a buffer of being a little bit more prudent. On the right-hand side, I've touched on cash realizations. This is the number 525 as of the end of March. We've delivered over 100 million in this financial year, but our target is 10% of the opening portfolio value. So in the case of having an opening portfolio value of 1.3 billion, we're broadly targeting 130 million for the year. And this year we should be delivering that. We're very close to that already. But like with other parts of the cycle, you'll see that it's quite lumpy. And so we've delivered over 16% of target returns, but it doesn't all come in a linear way. this slide shows you how those returns break down by the multiple of invested capital or multiple of invested capital on the outturn. So when we sell these companies and we get cash coming back in, we'll obviously look at the cash we invested versus what we delivered. 380 million, this is based on the previous number, 525, but 380 million of that comes in this 3x plus. So when I talk about venture being skewed to the winners, what we need to do is identify good companies, get in there early, sit with them on the journey, but then make sure that we're staying with them and doubling down on the best companies so that we can achieve these outsized returns. And our model of being evergreen does allow us to therefore sit with those companies for longer. When those companies exit, the majority of those have been trade sales, and in some instances we've had IPOs. So Trustpilot is a company that we owned 14% at the time of its IPO 3 years ago. In the other categories, you'll see that we'll have zeros, so you'll get no money on the left-hand side, and that's about 18% of our invested capital. And then you'll get less than 1x on another 24%. So this is a risk model. These can be good companies, but you can have problems with the timing of your investment, obviously, the timing of those companies coming to fruition, or the companies making decisions where they raise a lot more capital along the journey and you're pushed down in terms of your equity stakes, or taking on too much debt, as can sometimes be the case. And I would say that actually the time of the management team, a lot of it's spent in these two middle cohorts. And that's because those are the companies that we identify are valuable to somebody. They still have inherent underlying IP, they still have strong margins, but they aren't going to be the winners in this category. They're not growing quick enough for venture capital returns. And so we spend a lot of time making sure that we can move those businesses on, getting successful outcomes for the founders, but also to make sure that we can recycle the capital, and crucially that our investors who are sat on the boards of those companies can go on to the next opportunities as well. So managing the portfolio is a crucial part of the skill set. And I think when there's sometimes a misconception when I'm speaking to public market investors about what we do, certainly from the period of 2016 when we had a bit of feedback saying, well, we're stock pickers, that's what we can do. But in this market, getting your money into a deal at the right price is one component part, but then living with those companies for 7 to 10 years and then working out from a portfolio perspective how to manage your exits to get those returns, that's where the real skills come in. And I think we've seen a few circumstances where it proves that over time you really need to have that depth of experience. Just a couple more charts. So I touched earlier on income and costs. The left-hand side here is our costs in the salmon pink, and then the fee income that offsets those costs in the blue. So we still have a bit of a fee drag within that, but if you compare that to private market funds at a 2% management fee, it's substantially less than 1% for us because we have that income from other strategies that we're able to offset that cost base with. Obviously, as we grow third-party capital that's non-balance sheet, we can get to a stage where that can equalise as well over time. And then on the right-hand side, we're showing the evolution of the NAV as we scaled the balance sheet. And then clearly you can see in the last couple of years as that NAV per share has come down as the market has shifted for technology valuations. But I think the importance of the data we are able to now show in the public markets is showing that consistency over time and how the sort of through the cycle returns play out. So the final slide that I wanted to share with you was really thinking around how we look at an investment thesis. And a great example of that is how we thought about the fintech space, the technology that's underpinning people wanting to bank on their phones and having greater access to the financial markets led to a cohort of fintechs, if you like, neobanks. Revolut now being the key winner in that space, I would say. But also N26 out of Germany. And then you have other players like in Latin America, Nubank Holdings, which is listed in the US. And so we looked at this and we thought, well, okay, the first iteration of this theme will be consumers wanting a good user experience, so differentiated from what they get from their existing banks. And then they want something that's fast to transition, accessible to them whenever they go, when it's in their pocket. And so we started to look at the flow of funds. So where will the value accrue within that chain? And so we've put our first investments into companies like Revolut and N26 But we also looked at the democratization of capital, bringing more people into the ecosystem. And so we looked at companies like Crowdcube, which allows investors to put capital into private companies through pitches on the Crowdcube platform, and Free Trade, as I mentioned before, which is allowing people to trade stocks through the apps on their phone. And that was the first iteration of where we put investments to work, thinking around where would the capital go. But there was a second order effect of that, and we thought, well, how will the incumbent banks respond to that challenge? And this is where we started to look a bit more at the infrastructure layer and the cost base of all the banks and how much capital they're spending to look after their existing customers. But also, why is it that they can't innovate as quickly as the neobanks, even though they've got these years of experience? And here, without going into too much detail, because you're going to get a lot more clarity from Form 3 in a moment, but looking at core banking systems with Thought Machine and then payment systems with Form 3, we looked at the fact that banks currently have all of their tech and their legacy tech, and it's all built on top of each other, and it's cumbersome, and there's inherent costs, and it's liable to fall over and got regulatory problems with that. But all of the banks owned their own tech. And so we took the view that there will be a time when the banks have to move to a third-party provider for that technology, and that third-party provider will be able to improve the technology, run all of the patch updates, ensure that they are best in class, because they'll have enough customers by selling to multiple banks. And this was a thesis that we put our next layer of capital into. And I think the first investment into Form 3 was 2018, I think it was, which was the time when you were spinning out of Barclays. So with that, I will allow, and this is something we find at our investor days, and I certainly very humble about this, actually hearing it from the companies themselves is much more valuable. So with that, I'll hand over to Mike to give you a sense of Form 3.